Hi traders, welcome to this video. Today I want to talk about gap downs. A lot of people saw my video about FSLY and they asked me how I handled the situation, so the gap down situation in FSLY last week, and I decided to make a small video about that because I think it's very critical for traders, and especially new traders and young traders, to handle gap down situation and also to prepare for gap down situations. Okay, before we dive into the video, so please take a second and read the risk disclaimer. So this video is only for educational purpose. It is not an investment advice. So you are responsible for your trading and investment decisions. Okay, so let's dive into the topic. I start with some thoughts from myself. Take a big gap down seriously. They are a change in the long-term perception of the stock by market participants. This is especially true for large gap downs or big gap downs. When I speak about a big gap down, I speak about something like 10 to 20, 30 or even more percent. I don't speak about gap downs which happen from time to time and are only 3% or 2% or even 5%. No, I really speak about big gap downs, because those big gap downs, they are always created by institutional distribution, and the base of this distribution is a change in the long-term perception. So the people or the institutions who are looking at the stock are looking now with a different expectation and a different view on the stock. And when we speak about institutions, we always must have in mind that institutions are the only market participants which have the power to create those big gap downs. Institutions are typical mutual funds, banks, insurance companies, but also hedge funds and pension funds, of course. And they are the force behind every move in the markets. So they control billions and trillions of US dollars, and with their buying and selling, they influence the market over time. And when they change their plans, when they change their view on a stock, you as a retail trader, you have to adjust too, because otherwise you are on the wrong side of the market. And the thing is, when institutions, when their perception of a stock which they have in their portfolio, when this perception changes, they act immediately. You know, they don't have the problem that they say, oh, I want to do another research or whatever. No, they act immediately, because you must have in mind, they have not 20, 30 or 50% of their money in one stock. They sometimes have only 2% or 3 or maybe 5% when they are a little bit more aggressive of one stock in their portfolios. And when they reduce their portfolio positions, that means that they change from, for example, 2% to 1.5% or from 5% to maybe 4%. But the problem is the size of the institutions. When we as a retail trader, we sometimes have a 10,000 or 20,000 US dollar position in a stock, they sometimes have millions So 10 millions, 20 millions, or even 100 millions or more US dollar in one stock. And because of their extreme size, it's only a fraction of their portfolio. But when they start to sell, and especially much more important, when they stop to support the stock, then those big gap downs can happen. You know, when institutions say, okay, we want to distribute 0.5% of our portfolio in one stock to the market, and we stop every supporting of the stock. That means buying only little shares around support levels, etc. Then the stock really goes down. So always have that in mind when you look at gap downs. You know, they are always a combination of selling and missing support. It's not selling alone. It's also the missing support that creates those big gap downs. A lot of people also ask me about after hours and pre-market quotes, because the market reacts very quick, for example, when a news appears. And you can see this reaction in the after-hour markets or in the pre-markets. I personally, I look at after-hours and pre-market quotes, but I don't trade in the after-hours or pre-market sessions, because the prices are not more than an indicator. I had a lot of situations where a stock really went down in the after-hours market and opened the next day on a complete different price. So sometimes deeper, sometimes higher. And that's why I personally only trade in the regular sessions and do not use the after-hour or pre-market to sell or buy something. I personally think they are not reliable, and it's very hard to trade in those sessions. Another second point is, a lot of people ask, can I prevent myself from a big gap down? And I think no, you can't. There is no rule or no instrument where you can really prevent yourself from a big gap down. So, and that's why I say the longer you trade, the more likely it becomes that you have a large gap down against you. That's absolutely normal, because if you trade for a long term, then you have a long series of trades, and in a long series of trades, it's very likely that you will stumble upon one or two large gap downs. So you must learn to handle those situations. That's more important. And there are stocks in the market which have a higher risk of gap downs, and especially also big gap downs. Biotech stocks, you know them, biotech stocks, they are highly news driven. They are waiting for FDA approvals. They are waiting for trial series. They have no income. They have no sales. They have no business model. They are only dependent on money from big pharmaceutical companies. So, and when they have a bad news, they sometimes go down 50 or 70% or even more. Story stocks, another more risky type of stocks. Story stocks are typical very young companies which do not have any sales or any earnings, and the whole price movement is based on the expectation of a future success. Very prominent very prominent names are, for example, Nikola at the moment, or Workhorse, or other companies. Energies comes in my mind when I think about story stocks. So very interesting story, no sales, no earnings. And when something changed, so for example, we saw that with Nikola, they had problems with their founder, and they had problems with the general idea, and then a big gap downs comes into the market, And sometimes those companies do not survive. China stocks, another more risky type of stocks. Not all China stocks are very risky, but there are a lot of stocks which do not publish any audited reports, so it's much easier for them to have fraud and in their reports and manipulate the numbers. Turnaround stocks, also a more risky type of stocks, because not every turnaround is successful. You know, they have a lot of problems and turnarounds, and sometimes they have a lot of setbacks, and then you will see also big gap downs when a bad news appears. Stocks in a downtrend, that's also something I personally don't trade on the long side when a stock is in a downtrend, because you must always have in mind, is stock in a downtrend for a reason. People are paying less and less for the same company, and that is mostly based on an expected slowdown, or they expect that something changes in the industry. So, for example, institutions and investors expect a slowdown in sales or in EPS, or they know that there will become that there will be some restrictions in the future in the industry, or some changes in the in the law, and that will bring a stock into a downtrend. And stocks in a downtrend, you know, when everyone is in a bad mood and new bad news appear on your screen, it's very likely that they sell. And sometimes institutions are sitting on a large number of shares they have to distribute, and that will take them weeks or even months. So stocks in a downtrend, I personally don't touch them. Of course, they will sooner or later will turn around and then go up again, but before this turnaround, they go down for months or even years. Illiquid and cheap stocks is another thing I don't touch, because you must see, when you have a illiquid stock, that means the stock has not so much support from institutions, because institutions are more interested in liquid stocks. And when a small cap fund or a micro cap fund decided to sell a share from their portfolio, then only a very low number of shares can bring a stock to fall. So illiquid and cheap stocks are not something I'm interested in. Another thing is, and this is very important, is the last point here: survivorship bias. And this is something a lot of people underestimate. When you look at your screeners, when you look at the stocks you have on your watch list, you are only seeing the survivors. You are only seeing the companies which survived downtrends, down gaps, and problems and turnarounds and whatever. So they are the survivors. And all the stocks which are not around anymore, so from bankrupt companies, you don't see. And that's a problem. You know, if you now look at thousands of stocks and you say, okay, big gap downs are very rare, then I can say yes, but don't forget that there have been a lot of companies which are not around anymore, which do not recover from big gap downs. They went bankrupt. So have that in mind. It's very important when you look at the stock market. The most important point is, how can I manage my risk actively? This is the biggest weapon we as a trader have. A trader always have control over the risk. You decide where you put your stop loss. You decide how big is your position. You decide which stock you buy, etc. Of course, sometimes, especially with gap downs, you have the risk that you do not get stopped out at your initial stop loss level, so you have the risk of more to lose. But in the end, you have the control to sell the stock. So maybe a little bit more risk, maybe you lose a little bit more, but in the end, you have control over that. You decide when you exit. And when we look at the risk management side, I came up with 4 points here. Trade the right stock. I talked about that one chart ago. So don't focus on stocks which have a higher risk. Focus on stocks which are where successful companies are in the background. Stocks which have institutional support, so they are liquid and institutions are interested in them to buy more and support the stock. And also do not buy extended stocks. So if you have a stock which had a rally for 500% and it is trading say 200% over the EMA 200, this is very extended and a lot of people are sitting on big gains. And when bad news came out, they click the sell button and they have no problems to give back 20 or 30% of the gains. And but they want to get out. So focus on the right stocks. This is one of the first things we can do in risk management. The second thing is limit the position size. And this is very important. I personally, when I buy a stock, I always ask myself one question. How much do I lose when the stock gets 20% or more against me? So, and you know, I trade large position sizes. I have no problem to go long in a stock with 20, 25, even 30% or more. It always depends also on the profit cushion. But I always make this calculation in my mind. When I have a 20% position in a stock and the stock gaps 20% against me, that means I'm losing 4% from my total trading capital. And when I have a 30% position, in that case, it would be 6%. Of course, that is recoverable. So I can recover that. And it takes some weeks or maybe some months to come back. But it's possible to come back from such a drawdown. But if you trade, for example, a 100% position and it gaps 50% against you, you have a very big problem. And the same is true if you trade, for example, a biotech stock with a 30% position and you have a gap down of 70%. In that case, you really have a problem because you are sitting in a 20% or more drawdown. And that will take a long time to come back. So position size control is absolutely essential when you look at how to handle gap downs. Limit your position size. This is always important. So 20%, even 25%, or when you are very aggressive, 30%. But be careful with more than 30%. You must limit your position size to survive in the long run. The third point is know the dates. That's normal. You know, every professional trader look at earning dates and planned investor updates, or maybe also FDA approval or expected FDA approvals for biotech companies. And in that situation, when you know that the company will publish earnings next week, you can reduce your position size so that when a 20% gap appears on your screen, you do not lose so much. And the fourth point, and this is I think also important, is be aware of abnormal price behavior. When in doubt, get out, at least partially. Because especially with some type of stocks, the market knows more than you. And sometimes they expect that a company has problems with their accounting, or maybe there is some fraud ongoing, or the numbers are manipulated, etc. And before the news reached you as a retail trader, they started to sell, because they sometimes have insider information, or they know something, or they heard, they listened to a rumor, and the institutions then started to sell slowly into the market. And when the news comes out, in that situation, it's too late, because then the gap down happens. And when you look at price behavior, and it's very volatile, and it's not, and you don't see clean and steady and consistent price behavior, when there's something really, really ongoing, and you see distribution in a sideways situation, in a very volatile sideways situation, then be very skeptical. So when in doubt, when you have doubt about a chart, or doubt about a price movement, get out, sell something. So sell at least a few % of your position. So these are the 4 things where I say, okay, you have control over that, and these help you to manage risk actively. Now we come to the more practical part, 2 strategies to realize your losses. But because in every gap down case, when something gapped against you, you have a loss. So the goal is to preserve mental capital and be able to pull the trigger as fast as possible. This is important. When you handle a gap down, you want to preserve mental capital. That means you want to limit the danger, you want to limit the damage on your psychology and on your mindset, so that you are able to pull the trigger on the next buy opportunity. Because when you are confronted with a big gap down, and you're feeling very bad, and you have doubts about yourself as a trader, then you will miss the next big opportunity, because you have a so big obstacle to pull the trigger again. And this is what I mean here with preserve mental capital. So take a decision, realize the loss as fast as possible, to protect yourself and to protect your mental capital, so that you are able to click the buy button in the next second, not on the same stock, but on another opportunity. And this is important. It's not important to limit the loss to a minimum or something. It's much more important that you lose the connection, the psychological connection to this loss, to this to this event. So, and focus on the next trade. And you only have 2 possibilities to do that. The first one is take your loss as quick as possible and preserve mental capital. This is a way which is absolutely okay. When you have a gap down of 30%, click the sell button, sell your position, realize the loss. That's trading. No thing. You can also do it if you want it, you can do it in after hour markets. So when you see the stock is gapping down, click the sell button and goodbye. This is an absolutely okay way. You can do that, and it's very easy, and it helps you to preserve mental capital. I know a lot of traders who are doing that. And the second strategy is try to reduce the loss with intraday trading. That is something I do sometimes, not in every case. I'm also absolutely fine with the first strategy. So when I see there is a gap down and the stock open up 20%, and I say, okay, I see that the stock will go down much faster, then I sell and realize the loss. But sometimes I also try to reduce the loss with intraday trading. And this is something I want to talk about today. And yeah, let's switch into the trading station. I prepared some examples. So the first one, of course, FSLY. We will talk about that a little bit later. Here you can see the big gap down in FSLY on 15th October. But I also prepared some other example. One stock which remind me about FSLY is AAOI. AAOI had some big gap downs here in 2017. You can see it was a very strong rally. I bought the stock here. I sold it, I think, around that level here. So after it doubled, and I bought it back here. And I held it, through or until the $100 level. I took some profits here, and the stock gapped down extreme hard on earnings from this round $100 level. And that was a very big gap down, I think sometimes in the 20% area, 20 to 30% here. And that was a situation where I also applied my intraday trading strategy to reduce the loss a little bit, but not so much. Another thing was LKNCY, and LKNCY is a very good example of that the market is expecting something. I bought the stock around that level here, and I think I sold the half position around the 50 level here, and the rest I sold after the stock broke here the EMA 21 in that area. And then you can see that the stock went down on good volume, then went sideways, and then started another downtrend. And yes, that was also when the S&P 500 went down. But you can see that the stock was already in a downtrend before the fraud news came out here on the 2nd April. And the stock gapped down 70%. And it was delisted from the, I think it was the NASDAQ. And today it's only tradable in OTC market. You cannot trade that on the NASDAQ anymore. And it is a very big China coffee chain. So it's not a small company or something. But they had problems with fraud. And it gapped down 70% here. And you can see, the market knows more than you. It was already in downtrend. Gap downs also happen in big stocks. You can see that here with Intel, for example, with the last earnings report. The stock gapped down here more than 15%, so it was 16% down here on that day. And when you trade a more conservative stock, you normally have a bigger position size. And 16% is a lot when you look at that. Another candidate was here Alteryx, for example, with a gap down on earnings. It was also around here 30% on that day, so a very big gap down. And another one I want to show you is Corbus Pharmaceutical. And this is a typical gap down for a biotech stock. You can see that the stock, it went up from the EMA 65 here and EMA 21. It broke out above this highs here. And I think that it was not an all-time high, but it was above this $9 level here. And then a news came out, a problem with the trials. And then the stock gapped down 76%. And it lost around 80-90% around that level here from the highs. Very typical for biotech stocks. And when you have such a stock, nobody's looking at the stock anymore. Nobody is looking at them. But at that situation, a lot of people looked at them. It was very liquid. You can see it's traded more than 1 million. It had a market cap of 750 million at that time. So it was not a penny stock. And then a gap down happened, and the stock was coming very close to the $1 level. Another type of gap downs I want to show you is what Mark Minervini called a serial gapper. But the problem is serial gappers are very hard to find, and I only found this Weibo example here, and you can see that this stock here had a tendency to gap down, so it produced a lot of gap down. They were not so big, but there was a lot of gap downs, and this is a typical sign for extreme distribution from institutions. You know, Weibo was a very successful stock here in 2016, 2017. So that means a lot of institutions accumulated a lot of stocks, and then the perception of Weibo and the expected growth of Weibo changed here, and the stock came into a downtrend here, although the S&P 500 was up here. So that means institution expected a slowdown in the growth of the company, and they sold the stock aggressively on the downtrend here. And you can see that I prepared that also in MarketSmith here. You can see that Weibo really changed the sales growth and the EPS growth in December 2018. That was before the downtrend really started. And so that means here at the top, you can see institutions started to sell on slower or lower expectations of growth. And then you can see when the really gap down phases here started, that was when the numbers were on the table. So the market is much more clever and knows more than you. Okay, that was just to explain you different type of gap down situations. And now let's look at FSLY here. So the gap down happened here on October the 15th. And what I am doing when I see such a gap down, I switch to the 5 or 15 minute chart. So I personally prefer the 15-minute chart, but sometimes when the stock is very quick and very fast, I switch to the 5-minute charts. And now let's do that. And I also included the pre-market and after hour session here. So let's look at that. Here you can see this orange session here. That is the after hour session. And you can see the big drop at 10 and 10:05, and you can see the stock gap down or went down 20% in just 5 minutes. So that means there was really a lot of intraday action, but the volume was not very high. And then the stock was went sideways here in the after hour sessions and in the pre-market session. That's the yellow one here. And don't make the mistake, you can see this big bar here, but if you switch to lower time frames or if you trade in the after hour sessions, it does not mean that you get an exit at 120 or something. Maybe you are lucky and you get an exit at 120, but it's more likely that you get an exit much deeper here. So, of course, when I open up my trading station and I look at the pre-market quotes and I see that the stock is 20% down, of course, my first reaction is always, oh my god. Then the second reaction is, I have a strategy for that. So I can do nothing to get the money back. So I have to handle the situation correctly. And in that situation, I wait for the first 5-minute bar. And the first 5-minute bar is this one here. And you can see that the low of the first 5 minutes is around the lows here from the pre and after hour market session. And that's important because when I open up the trading station, I always place an initial stop loss order and I place it below the lows of the after hour market session or from the pre-market session. So I'm willing to risk a little bit more, just a little bit more, just a few percent more to reduce my loss a little bit. Because if you see a 20 or 30% gap down, it's very likely that the stock will bounce a little bit. So in that case, when I see the lows are here, I'm just placing my stop loss a little bit lower. So around this 84 US dollar level. So 84.50 I think was my low. So very close to that here. 84.50 was my stop loss. So very close to that. And you can see it was only around around 2% below the lows here. So just a very little more risk to reduce the overall loss. And then I monitor the price. So and when now the price falls below my stop loss, I'm out. I realize the loss and I go away. So no problem. But sometimes, as in that case here with FSLY, you see a very strong reaction to the upside here in the first minutes. So it was up 2% here, then it went sideways a little bit, and then it went higher. And then sometimes you see those swing lows. A swing low is something like that one here. So you can see a lower low was produced here. So the price fell below the low here of the candle. So it just a little smaller lower low here. And then the price went up again. In that situation, when I see that the price is up, I move my stop loss from here to the low of the candle or to the bar here. So very small, a very simple strategy. And and then you can see here happened the same thing. In that situation, I place my stop loss or I move my stop loss higher as soon as the price moved higher here. And I always place my stop loss just a few cents, or in that case here, because it's a 100 US dollar stock, a few dollars below the low here. And as soon as we see a new high here, so that means this high was broken, in that situation I move my stop loss higher. You can see it was not broken here, and then I moved my stop loss with a strategy to that situation, and then I get stopped out here. So, and you know, it's really not about that you make or that you recover the loss completely. That's not the thing. I just want to make sure that I reduce my loss a little bit. There have been situations in the past where I was able to recover from the loss almost to the break-even level. But there was also situations where I get stopped out very, very quickly. So, but it helped me to reduce my loss a little bit, and it also helped me to preserve mental capital, because I can reduce my loss here in that situation. So I got stopped out here when this last low here was broken, and I sold the whole position in that situation. It is absolutely not recommended. I don't recommend that, to hold a losing position, especially in such a big gap down situation overnight. So because you never know if another bad news follows and then it will gap down the next day again. And it's better to really sell your position as fast as possible. So this is a very simple strategy, but please have in mind that this is only for very experienced traders, because you must have the mindset and the discipline to follow the strategy intraday. And that means bar by bar. You don't have so much time to think about that. You must really only adjust the stop loss orders, and you must really have the discipline to stick to that stop loss order and do not extend it or whatever. So, and it's really a strategy to reduce the losses. It's not a strategy to hold the stock for a longer time or something, to expect that the stock will come back or something like that. It's really only a strategy to reduce losses, because always have this AAOI example in your mind. You know, you can see that here, big gap downs, then going nowhere, another big gap down, and then another big downtrend. And in that situation, AAOI lost 80%. And you must always have that in mind, you know, when a trade or when the perception of institutions changed about a stock and the market is looking different at the stock, they will not change it in one day. You know, they will change it when the situation of the company will change again. And institutions sell over weeks and over months, and they create gap downs and they create the trends. So have that in mind when you think about to hold a gap down stock and think that it will recover. The most will not recover from such big gap downs. Okay, that was a long video, but I think it was very important to give you the right context and to give you all the information I talked about at the beginning, because the strategy itself is very simple. So, but how to handle gap downs and what is behind a gap down is really important to understand, so that you as a trader and as an investor can maybe develop your own strategy or can adapt to this new situation in your stock. Okay, I hope that this video helped you. You can follow me, of course, on YouTube, on Twitter, Instagram and Facebook. And I recommend to subscribe my free newsletter. I send it out every Sunday with trading tips and 3 stocks from my personal watch list.